You can't build anything big without a proper foundation. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our EncycloMedia series, we're going to discuss the base policy, base premiums. So the base of a whole life insurance policy is just that. It is the chassis. It is the skeleton. It is the framework. It is the foundation. It is the base of the policy. Now, for those that are looking to implement infinite banking as described and codified in R. Nelson Nash's book, Becoming Your Own Banker, you are going to want to use a properly structured whole life insurance policy from a mutual company that pays dividends. But there are multiple parts, or there can be multiple parts or aspects to that policy. But again, the framework, the skeleton, the foundation, the base is a whole life insurance policy contract itself. And then there can be riders attached to that, a paid up additions rider, perhaps a term rider, and other riders. And all of those additional riders, you can find out more on our channel in this particular EncycloMedia series. But the base premium pays for the base whole life insurance policy. So there's this set amount of premium, level premium, that one would pay for whatever the style policy is. 10 pay, 20 pay, paid up at 65, paid up at 75, 121. So that's just describing how long you would pay a level premium, and that level premium is going to buy you a level death benefit. And then again, with the correct riders attached to that policy, you can increase to have a significant amount of cash value early on with the policy, and that will grow the death benefit as you continue to pay premiums. But I'm addressing this subject of the base premium, buying the base policy, for a few reasons. One is because it is overlooked too much, even in the infinite banking space. Having a robust base premium is an important aspect of thinking long range, as Nelson Nash would say, and not being afraid to capitalize. Those two in particular are his first two principles to infinite banking. Think long range, don't be afraid to capitalize. So having a robust premium amount that you're paying for a base policy, a base and level death benefit, is important, because that gives you the foundation, the base, on which you can build something really significant with these other riders as well. The other reason why I want to talk about base premiums and the base policy is because I will often be speaking with somebody at some point in their exposure to infinite banking, and they will perhaps have seen a policy illustration or even be looking at one with me, and I will actively point out where in certain pages of an illustration, and please don't look at a policy illustration without looking at all of it, no matter what kind of policy contract it is. Look at the full policy illustration, not just pages, but make sure you have access to all of it. But there are going to be pages on that policy illustration where it will say cash value 0 when you're just looking at the base policy itself. And this is where Dave Ramsey will jump in and say, well, that's not going to have any cash value for 10 years maybe. And he'd be right if you were only looking at that portion, that part of the base policy itself, without any of the riders that would be attached on a properly structured policy. There will be no cash value perhaps for several years even, or very little for several years. And if someone just looked at that part of the policy illustration without looking at the other parts to get a collective picture of how that policy has been constructed, then you'd be missing out on the full picture information, obviously. So it's natural to find pages on even a properly structured policy where portions of the policy have a $0 cash value in the early years. Now, the reverse is also true, that when a policy has been built robust, strong, tough, it's going to have a significant portion of the total premium that goes to the base. And I have covered policy splits on this EncycloMedia series. So make sure to check out the policy splits episode where I go on a deeper dive here. But the base premium is what is going to produce multiples of itself in the later years of a policy when a policy gets more and more efficient. $1 of premium to the base policy is going to create multiples of itself. And the longer that it's enforced, the greater that exponential curve increases. Also, when companies pay dividends, they pay dividends more heavily weighted towards what percentage of your total premium actually goes to the base. So that's just some word of caution when looking at a policy illustration. Make sure you're looking at all the values so you don't mistakenly think that a policy doesn't have significant cash value just because you're looking at the base premiums and the base values. But also recognize the power that the base premium has as the foundation of an infinite banking style policy to provide you with significant dividends later on and the ability to capitalize for sure for a much longer time. So if you got value on how to live and leave a lasting legacy from this video, subscribe to our channel here. Subscribe to our channel here. So if you got value out of this video, make sure to subscribe to the channel here, and I'll see you on the next video.